Swiss banking secrecy is at an end. Switzerland is about to begin exchanging data with 38 different countries alongside the OECD. Where are the loopholes? Drazen Turujlija, Switzerland's at a historic moment in that Swiss banks are about to begin trading data with 38 different countries. Now, the standard that they've agreed on is something called the Common Reporting Standard, the CRS. How airtight is it?
It has to be noted that, that the CRS is a global standard that has been elaborated in record time, which means that it is not perfect. Nobody pretends that it is, not even the OECD. Now, if the question is, are there any loopholes in the CRS, then the answer is yes. There are about 20 loopholes that have been identified.
Okay, so in this kind of elaboration of the Common Reporting Standard, it is flawed, as you say, and imperfect. Can you give me an example of a loophole?
Well, let's take the most commonly used one, fake residency certificate. Now, it is obvious, and everybody knows that nowadays it is quite easy to get a tax residency certificate in some zero-tax countries. All you have to do is to invest a certain amount of money, even if you don't live there actually. So once you get your tax residency certificate, you can go to see your banker and you pretend that you have changed your residency. So the consequence will be that the bank will exchange the information with the zero tax country and not with your country of residence.
So somebody could look quite harmless on paper, but in fact have quite a liability that the tax authority is not aware of at all.
Exactly.
What is the OECD aware of that, and what is it doing to shut it down?
Well, OECD is aware. If we take the example of this precise loophole, the OECD will amend the CRS in a way to require that all the residencies in the past 10 years will be considered as a current tax residency. So the consequence of this will be that the information will be exchanged with all of these countries. And the only way for the taxpayer to prevent this from happening will be to secure a tax clearance certificate issued by the local tax authorities. And probably what will happen is that this certificate will be only issued after a detailed tax audit.
And what happens exactly if a certain country or several countries, for example, don't play ball?
Well, simply what will happen is that they will be blacklisted, which comes along with some sanctions. So, for example, we could envisage that all the passive income that will be paid to a blacklisted country will suffer a higher withholding tax. France is currently levying 75% withholding tax on such income. This is something that could be envisaged under the CRS as well. Another example, a country which does not comply with the CRS could simply be excluded from the SWIFT payment system, which means basically that you don't do business anymore from this country. Now, I'm pretty much sure that this will be sufficient to ensure that everybody plays the game.
I see what you mean, to bring everyone into line to avoid that nuclear option of being cut off from the SWIFT system. How long do you think it will take the OECD to correct some of the kinks in this CRS, for example, this fake residency?
Well, non-official information is that this might happen in July this year, but of course it's an ongoing process.
Very interesting on the automatic exchange of information. Thank you very much, Drazen Turujlija.
Thank you.
And that was FinNews TV in cooperation with Dukascopy TV. Please join us next time.